Most people trust their bank completely. It's where their paycheck goes, where they save money, and where they manage their financial life. But what many people don't realize is that banks are constantly making money from customers in ways that feel invisible because they've become normalized over time. Monthly fees, low savings interest rates, inflation, overdraft charges, credit card interest, lending spreads, and hidden financial behaviors quietly drain money from millions of people every single month without them fully noticing it. Today we will talk about your bank is legally stealing from you every month. Here's how. So, before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people think banks exist to help them grow wealth. For most people, banks feel safe, trustworthy, and necessary. Your paycheck goes there, your savings sit there, and your bills get paid through it. Banks market themselves as financial partners designed to protect and grow your money. But the uncomfortable reality is that banks are businesses first. Their primary goal is not to make you wealthy. It is to make profits from the money you keep inside their system. 9. Inflation quietly reduces the value of your savings. One of the biggest ways banks indirectly benefit is through inflation. Most savings accounts pay extremely low interest rates compared to the rising cost of living. This creates a hidden problem. Even though the number inside your account may stay the same or grow slightly, the purchasing power of that money slowly declines over time. If inflation rises faster than your savings interest, your money is effectively losing value every year while sitting in the bank. Many people believe they are being financially responsible by saving cash, but in reality, their money may be shrinking in real terms, without them fully noticing it. 8. Banks profit from the gap between borrowing and saving rates. Banks operate heavily on interest spreads. They pay customers very small interest on savings, while charging significantly higher interest rates on loans, mortgages, and credit cards. This gap is one of the core engines of banking profits. Your deposited money becomes capital the bank can lend out repeatedly at much higher rates. In simple terms, banks often make far more money using your money than you make by storing it there. This system is completely legal and fundamental to modern banking, but most people never think deeply about how uneven that relationship actually is. 7. Monthly fees slowly drain wealth over time. Another hidden issue is banking fees. Maintenance fees, overdraft fees, ATM charges, transfer costs, foreign transaction fees, account penalties, and credit card interest quietly remove money from millions of people every month. Individually, these fees may seem small, but over years or decades, they add up significantly. Banks understand something powerful about human psychology. Small recurring charges are less noticeable than large one-time losses. Because of this, many people continue losing money slowly, without ever calculating the true long-term cost of these financial leaks. 6. Credit cards are designed to keep people paying interest. Credit cards can be useful financial tools when managed carefully, but banks make enormous profits from people carrying balances month after month. Minimum payment structures encourage long repayment timelines, while high interest rates quietly increase total debt costs dramatically. Many consumers focus only on whether they can afford the monthly payment, rather than calculating how much interest they are paying over time. Banks benefit heavily from this behavior, because long-term debt generates recurring profits. The system rewards people who borrow continuously, not people who escape debt quickly. 5. Your money often works harder for the bank than for you. Most people deposit money into accounts where it earns little to no meaningful return. Meanwhile, banks use deposited funds to support lending, investments, and broader financial operations, generating substantial profits. In other words, your money becomes an asset working inside the banking system continuously, even while your personal returns remain minimal. Wealthy individuals often understand this dynamic differently. Instead of leaving large amounts of cash sitting idle, They focus on putting money into productive assets, capable of growing faster than inflation over time. 4. Banks benefit from financial illiteracy. Another reason the system works so effectively is because most people never receive proper financial education. Schools rarely teach how interest compounds, how inflation affects purchasing power, how debt traps work, or how banks generate profits. This lack of understanding creates dependence on financial systems people do not fully understand. Banks do not need to force bad financial decisions. Many consumers make them naturally due to limited education around money management. Financial illiteracy quietly becomes one of the biggest profit drivers in modern finance. 3. Convenience often comes at a financial cost. Modern banking systems prioritize convenience, but convenience can become expensive. Instant loans, easy credit access, buy now, pay later systems, automatic financing, and frictionless spending tools encourage higher consumption and debt accumulation. Banks understand that reducing friction increases spending behavior. The easier money feels to access, the easier it becomes for consumers to overspend, without fully realizing the long-term consequences. Convenience may feel harmless in the short term, but over time it often leads to larger debt burdens and reduced financial flexibility. 2. The wealthy use banks differently than ordinary people. One major difference between wealthy individuals and average consumers is how they interact with banks. Ordinary people often use banks mainly for storage, borrowing, and spending. Wealthy individuals use banks strategically. They focus on leveraging capital for investments, minimizing unnecessary fees, accessing favorable financing, and moving money into productive assets that grow over time. Instead of allowing inflation to quietly erode cash savings indefinitely, they prioritize ownership of businesses, real estate, stocks, or other assets capable of compounding wealth long-term. 1. The real way banks quietly take money. The deeper truth about banking is not that banks are secretly robbing people illegally. It is that the financial system quietly rewards passivity, while financially educated individuals learn how to make the system work for them instead. Because the truth is simple: inflation, fees, debt interest, and low-yield savings slowly reduce wealth for people who leave money sitting still without strategy. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.